Dividend increases can tell a lot about a company. Not only does it mean you're getting more money paid out to you as a shareholder, but it signals how the management of a company thinks about their business and future growth. And this week we have a really important dividend increase coming from United Health, ticker symbol UNH. This company has sold off over 50% from its recent high, which gives the company one of the highest dividend yields in its history. So today I'm going to give you an updated look at United Health's latest dividend increase and what the lower 5.2% raise says about its long-term prospects and whether or not this could be a good buying opportunity. On top of that, I'm going to share 5 more important dividend raises that you should know about from the past couple weeks. That includes dividend growth giants like Lowe's and some interesting oil and gas stocks like EOG Resources. But first, I want to thank our sponsor, Seeking Alpha. They are the official partner of Dividend News for DividendData.com. And if you use the links in the description and pinned comment, you can support the channel and let them know we sent you. We have an exclusive deal where you can get $30 off a Seeking Alpha membership. And there's a 7-day free trial, so no risk in trying it out. We also have a deal where you can get $50 off Seeking Alpha Alpha Picks. Since launching in July 2022, that's had a 168% gain compared to the S&P 500 at 57.1%. So again, the links to these exclusive offers are in the description and pinned comment of the video. With that said, let's roll the intro and get into the dividend news. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. I've been posting a lot of stock analysis videos recently, including some I'm going to be talking about today, like United Health stock. This dividend news is all available on DividendData.com, and you can filter by all payments, increases, decreases, and special dividends. And you can also filter by just the stocks you own and have on your watch list. The first company I'm going to cover is United Health, ticker symbol UNH. They just raised their dividend payment by 5.2% to $2.21. This is up from their prior quarterly dividend of $2.10, and it gives them a forward dividend yield of 2.99%. That dividend will be payable on June 24th for shareholders on record as of June 16th. United Health stock is down over 50% since April, and the sell-off has potentially created one of the best buying opportunities ever for this dividend growth machine. As you can see, UNH stock has been growing its earnings per share at a high rate for a number of years, and this has led to incredibly high dividend growth. The 10-year compound annual growth rate of the dividend is 16.02%. However, this latest 5.2% increase is a notable slowdown. In fact, this is the lowest dividend increase ever in the history of United Health. So on one hand, it's great that management is comfortable enough to increase their dividend on the exact same pattern of increases they always do, but this dividend raise is also very conservative. For context, the prior raises were 11.7%, which was already a slowdown from the dividend raise before that at 13.9%. Financially, the company is still in a very strong position with a 36% free cash flow payout ratio, and it's typically always in this 20 to 40% range. And based on net income, the payout ratio just hit 52%, but that was kind of an outlier low net income year for UNH. As you can see, when we look at their net income per share, they had one quarter with a loss, and that was likely due to some write-down in GAAP accounting. So UNH is still financially very healthy, and I would say this 5% dividend raise is a signal of confidence from the management of United Health. And I would not at all say that this lower dividend raise gives any credibility to claims that they're worried about potential lawsuits from the DOJ or the news of their CEO leaving the company. I cover all of those key reasons why UNH stock is selling off in my recent United Health stock analysis video. If anything, I think that 5% dividend raise is due to the fact that they're expected to have an earnings decrease in fiscal 2025. As you can see, analysts' expectations are that earnings per share will decline by 18.6%. However, since the company has sold off so much, that's still an attractive valuation with only a 13 PE ratio. And expectations are they return to double-digit earnings per share growth in the years thereafter. And if they do that, then United Health stock looks like a steal. They're projected $40 in earnings per share in fiscal 2029, which would give it a 7.4 PE ratio at current prices. And the current 2.92% dividend yield is historically high and looks like a great buying opportunity. This is not only the highest yield by far over the past 5 years, but it's the highest starting dividend yield ever in the history of the company. And this is a stock which historically has been a huge compounder in the stock market. Since 1990, this company has a total return of 102,000%, and that's after selling off 50%. The company over the past 5 years is still positive in total return, even with that 50% sell-off. So if you're a dividend growth investor, this is a stock you should probably be doing your research on and have on your watch list. The second dividend raise I'm going to share today is from Donaldson, ticker symbol DCI. They just raised their quarterly dividend payment by 11.1%. This increases their quarterly dividend to 30 cents per share from their prior dividend of 20 cents a share. That is payable on June 30th for shareholders on record as of June 16th. And as we dive into this stock, it's had surprisingly good financial performance. As you can see, their earnings per share reliably grow at a mid-single digit rate, and the stock price has largely followed that over time with a few dips along the way. However, this company does have an impressive track record of dividend growth. With a forward-looking annual dividend of $1.20, it has a current dividend yield of 1.71%, and it's very sustainable with a 30% payout ratio. This quarterly dividend has grown at a 5% 10-year compound annual growth rate, but dividend growth has been accelerating in recent years. The 3-year CAGR is 9.26%, and as I mentioned, they just declared an 11.1% dividend increase. The Donaldson dividend is always in a sustainable range. The free cash flow payout ratio has been around 30% in 3 of the last 4 years, and it's also very healthy in this 30% range based on net income. And if we look at the dividend yield for DCI stock over the past 3 years, this current yield is pretty much in the middle. And as we zoom out to 5 years, you can see it never really gets above a 2% starting dividend yield, and it's been as low as a 1.3% dividend yield. So this current 1.7% is pretty good. Since 1990, the stock has a 12,000% total return, and the 5-year total return currently sits at 48.9%, and the stock is down 2% over the past year. Stock number 3 I'm going to share today is EOG Resources, ticker symbol EOG. This is an oil and gas company that just raised their dividend by 4.6%. This brings the quarterly dividend to $1.02 per share, which is up from the prior dividend of 97 cents per share. That will be payable on October 31st for shareholders on record as of October 17th. I haven't done a deep dive on this company in the past, but I was looking at their financials and it seemed pretty attractive. This is an oil and gas exploration and production company, so you will see that their earnings and stock price fluctuate a lot over time depending on how the oil and gas business is. It is highly dependent on the commodity price of oil. So there will be boom times where it's highly profitable and also bear markets where they may be losing money, and the stock price largely follows that. But right now, it looks like EOG Resources is raking in cash, and they're trading at a reasonable valuation of 10 times earnings. And I'll tell you what, this is actually a great dividend growth stock as well, because one of the main things I get concerned with when I look at oil and gas stocks is how they cut their dividends during those bear markets. However, EOG Resources has been consistent and reliable with their dividend payment and grown it over time. And when possible, it looks like they try to have annual dividend increases. But this is what's really interesting. See all these spikes here? They paid a flurry of special dividend payments during that oil boom. So this 3.58% dividend yield is based on their base quarterly dividend. So you were getting those special dividends on top of it, sometimes as much as $2 per share. The dividend for EOG Resources has grown at a 19.8% 10-year compound annual growth rate, which is very high for oil and gas. The 3-year CAGR is 10.79%, and the payout is very sustainable at around a 30% payout ratio based on that quarterly dividend. And this is an important thing to think about whenever you're analyzing a company with special dividends. You always want to calculate the payout ratio based on the base quarterly dividend. If you don't think about it that way, you could have looked at fiscal 2022 for this stock and been, 230% payout ratio, it's unsustainable. But no, on top of dividends, the company has even been repurchasing shares in recent years. As we look at EOG Resources, you can see growing revenue per share over the long term. Free cash flow per share has been very strong recently and looks to be reliable. Although from 2006 to 2017, they were nearly negative every single year. And the company's in a pretty good financial situation too. They have $6.5 billion in cash and short-term investments, and they have negative net debt at negative $1.5 billion, so they have more cash than total debt. So I actually kind of like this stock as I was analyzing it, and I did add it to my personal watch list. And as we look at the company's dividend yield, they are historically trading at a relatively high starting yield. Remember, these other calculations are based on including those special dividends, so that's not based on the base quarterly dividend. The dividend yield right now is nearly as high as the stock was in 2020 based on their quarterly dividend. Since going public in 1990, the stock has a total return of 5,700%. The 5-year total return is pretty good at 133%. However, they have been flat over the past 3 years with a negative 9% total return. Stock number 4 I'm going to share today is Lowe's, ticker symbol LOW. This is the home improvement retailer I'm sure all of you are familiar with. They just raised their quarterly dividend by 4.3%. That gives them a $1.20 per share quarterly dividend, which is up from the prior dividend of $1.15. And this dividend raise will be paid to shareholders on August 6th for shareholders on record as of July 23rd. Lowe's stock has historically been a great performer in the market. However, they have largely been flat over the past few years, and they peaked in earnings per share in fiscal 2022 and have slowly been declining since then. However, analysts are projecting a return to earnings growth. For a number of years, Lowe's stock was a dividend growth machine. They had a 10-year compound annual growth rate of 15.67%. And I remember back during 2021 and 2022, their increases were gigantic. As you can see, they had a 33% increase followed up by a 31% increase. Since then, dividend growth has slowed down a lot with a 3-year compound annual growth rate of 4.55%. So this latest 4.3% increase is in line with that. The current Lowe's dividend yield is 2.13%, and that payment is very sustainable based on their free cash flow and net income payout ratio. The free cash flow payout ratio is 33%, and the net income payout ratio is 36%. And on top of this, Lowe's has been buying back stock like crazy. It was as much as 7 and even 9% a year. However, those share repurchases were largely funded with debt, which in my opinion is a little risky. As you can see, their net debt has grown over the past decade, and it's now up to positive $36 billion. This company is very profitable and generates a lot of cash flow, but I really think they just went overboard in 2021 and 2022. As you can see, they were repurchasing $13 billion worth of stock and $14 billion worth of stock when their free cash flow is 8 and 6. It's just unnecessary. Since then, they've been a lot more reasonable, and in this past fiscal year, they generated $7.7 billion of free cash flow, and they bought back $4 billion of stock with $2.57 billion of dividends paid. So in terms of returns to shareholders, they're still buying back more stock than they are paying in dividends. But the big thing with Lowe's stock, if you were to buy it right now, is whether or not they will continue growing earnings again and how fast that will be. The current analyst expectations are 2.8% earnings per share growth this fiscal year, ramping up to 8%, and then we're back into the double-digit earnings per share growth. So we're likely a few years away from dividend growth accelerating again at Lowe's stock. The current dividend yield is on the higher end of the past 5 years, but it has been as high as 2.4% in the past. Since 1990, Lowe's stock has been a great compounder in the market with a 38,000% total return. The 5-year total return on the stock is 88%, which is still very good. However, the 3-year total return is a little bit lower at 22%, which really is not that bad at all. For stock number 5 of this dividend news video, I'm going to share Genpact, ticker symbol G. They just raised their quarterly dividend by 11.5% to 17 cents a share. This is up from the prior dividend of 15 cents a share, and that dividend increase will be payable on June 30th for shareholders on record as of June 18th. I'm not super familiar with this company, but I thought the financials were interesting enough to share. It appears this company does business outsourcing and IT outsourcing in India, and it looks like they've done pretty well with growing earnings per share over time. This is actually pretty reliable growth, and they've been paying a quarterly dividend since March 2017, and I believe this is their 9th dividend increase. The current dividend yield is 1.58%, and the payout ratio is very sustainable at around 20%. The 5-year compound annual growth rate of the dividend is 11%, and they basically are doing 10% raises every single time, and it is always in a very sustainable payout ratio. The company has also been buying back stock regularly. I'm not really that blown away with this company. Since 2008, they have a 240% total return. That's a 19.9% total return over the past 5 years. And the yield's a little bit on the higher end over the past 5 years, but it has been as high as 2% in 2024. So those are 5 dividend raises worth knowing over the past couple weeks. And if you want to use the stock research tool I showed throughout the video, it's all available at dividenddata.com. We currently have a summer sale where you can get 50% off our annual membership. There's a 30-day money-back guarantee, so no risk in trying it out. And if the tool helps you find just one better stock, then it way more than pays for itself. And if you join in the next 2 days, you get a free gift, which is an educational product we put together called Master Dividend Investing in 7 days. It shares a deep dive into my dividend investing strategy and a curated list of high-quality stock picks so that you can get started faster. To get access to this sale, click link in the description and pinned comment of the video. If you want to see future stock analysis content, subscribe to the channel and I'll see you in the next video.